Welcome back, Focus Learners, to another explainer. So, looking at the crypto market today, August 9th, 2026, I gotta tell you, it feels exactly like one of those high-stakes, epic anime showdowns. You know the ones. The energy is crackling, the ultimate attacks are charging up, but neither side has struck the final blow just yet. We're gonna break down the raw data today to show you exactly why the market is suspended in this incredible tension and what it's gonna take to break it. Okay, let's dive into this, because this number right here, this is the ultimate institutional power-up. Over the past week, we've seen a massive $1.1 billion in net inflows hit US spot Bitcoin and Ethereum ETFs. And look, this isn't just retail pocket change, right? This is heavy institutional capital entering the battlefield. For 5 consecutive days, Wall Street has been relentlessly accumulating, which is providing a massive structural floor for the entire market. But here is the massive paradox that has everyone honestly kind of scratching their heads. Despite this billion-dollar injection of pure buying power, Bitcoin's price is completely stalled. It's essentially flat, hovering right near that $65,000 mark, which begs the ultimate question, doesn't it? If the biggest players in traditional finance are buying with this much force, who exactly is on the other side of the trade absorbing all that pressure and keeping the price locked in place?
Well, what we're witnessing is a direct head-to-head clash, institutional greed versus retail fear. While the ETFs are out there aggressively accumulating, we're seeing persistent exchange selling and derivatives hedging coming from the retail and crypto-native side. Retail investors are incredibly skeptical right now, and they're basically using these institutional buying waves as exit liquidity. It creates this perfect equilibrium of opposing forces, literally freezing the market in its tracks.
Let's move to Section 1, the 65K boss level, also known as the compression phase.
Right now, Bitcoin is trapped in a really tight technical band, just bouncing between $64,000 and $65,300. Analysts are calling this a compression phase. You can think of it like a coiled spring being pushed down tighter and tighter. Every single day the price stays in this narrow channel while billions flow in, that potential energy just builds. The whole market is essentially holding its breath, waiting for a decisive move that will finally snap the spring and dictate the next major trend. So the crucial point is understanding exactly where the ceiling is. This quote from analyst Axel Adler Jr. really hits the nail on the head regarding the invisible defensive shield just overhead. See, the average cost basis for a short-term holder, meaning someone who bought in the last 155 days, is $67,523. Because the price has been below this for months now, a lot of these holders are sitting on losses. If the price rallies toward that 67.5K mark, human psychology just kicks in. They are highly likely to dump their coins just to get their money back at break-even, and that creates a massive, invisible wall of sell pressure.
Moving on to Section 2, Institutional ETF Power-Ups, or the Bull's Ultimate Attack.
Now, what's really interesting here is just how incredibly concentrated this buying power actually is. Over a 5-day stretch, Bitcoin ETFs alone saw $853.5 million in inflows. But get this, 81% of that is entirely BlackRock's IBIT ETF. BlackRock is absolutely dominating the landscape right now. It shows relentless, concentrated demand from the world's largest asset manager, totally regardless of the short-term price chop we're seeing.
And you might think this is all just built on pure hype, but it's not. The Crypto Fear and Greed Index is sitting at a fearful 31 out of 100. Retail commentary has hit multi-year bearish highs, but counterintuitively, this is incredibly constructive. A fearful market means we aren't overcrowded with highly leveraged, euphoric long positions. Funding rates are practically neutral. It means this rally is being built on actual spot buying, real capital, and not borrowed money that could easily trigger a nasty cascade of liquidations. Let's zoom out to Section 3, the macro battlefield, and these environmental field effects. The broader economic climate just handed risk assets a massive tailwind. The U.S. July jobs report came in shockingly weak. The market fully expected a gain of 80,000 jobs, but we actually saw a loss of 23,000 jobs. Because of this weak data, the market immediately slashed expectations for a hawkish Federal Reserve. The odds of a rate hike plummeted to 42%. In the financial world, bad news is good news. This economic weakness signals easier money ahead, which is literally the perfect environment for crypto to thrive.
And this brilliantly illustrates how different parts of the crypto market react to macro shifts. According to a new research paper analyzing Kalshi prediction markets, we see a really distinct split in behavior. Bitcoin's volatility responds aggressively to shifts in monetary policy, like the Fed turning dovish. But altcoins, things like Ethereum and Solana, they are statistically much more sensitive to inflation data, specifically the CPI signals. So they're fighting on slightly different macro fronts.
Now for the negative catalysts. Section 4, hacks and regulatory delays, or the incoming debuffs.
First up, we have the cold card hardware wallet exploit. It was a devastating blow to the self-custody community. We're talking $130 million drained by over 15 independent attackers, and they all exploited a firmware bug dating back to March 2021. Yet, despite the massive shock to the cypherpunk ethos, what did Bitcoin's price actually do? It completely shrugged it off. The broader market treated this as an isolated product failure, not a systemic threat, proving incredible structural resilience in the face of what would normally be crippling bad news.
Then there's the regulatory front, the Clarity Act, which is a pivotal market structure bill the industry has been eagerly anticipating. Well, it's been delayed by the U.S. Senate until after their August recess. Senate Majority Leader John Thune did schedule a cloture vote for September 15th to try and push it forward, but polymarket prediction odds currently price the chance of the bill passing into law in 2026 at just 21%. While this delay is definitely a short-term hurdle, the fact that the market hasn't tanked on the news shows investors are pricing in a longer, much more resilient timeline for institutional clarity.
Let's move to and see how this builds into Section 5, altcoin momentum and their independent side quests.
While Bitcoin holds a massive 59% of market dominance, several altcoins are embarking on their own independent side quests. Take XRP, for example. It's actually outperforming the broader market today. This momentum is fueled by a brand new proposal for the XRP ledger called confidential transfers. This upgrade uses zero-knowledge proofs to encrypt transaction amounts. And it's a huge deal because it directly targets the needs of traditional institutions. It offers them the data privacy they require to tokenize real-world assets while still allowing permissioned access for regulatory compliance. It is basically the perfect technical bridge.
Meanwhile, the Ethereum ecosystem is pushing some serious speed limits. WorldChain is set to launch its mainnet on August 17th, utilizing a major upgrade called EIP 7928. This introduces streamed block-level access lists. So instead of a network verifying transactions one by one, this upgrade allows validators to process them in parallel. They're targeting an insane throughput of 1 billion gas per second. And the best part? It's all activated via a runtime flag without needing a hard fork. These are the fundamental upgrades quietly building long-term value in the background.
Bringing us to Section 6, forecasting the breakout and the final showdown.
To finally break this stalemate, the entire market is basically holding its breath over the weekend, waiting for Monday, August 12th. That is when the new US CPI, or inflation data, drops. As we saw from that Kalshi prediction data earlier, inflation metrics are the exact trigger point for altcoin volatility, and they'll provide the ultimate confirmation for the Fed's next move. This is exactly the catalyst traders are waiting for before they commit fresh capital.
So to officially win this phase, the bulls have to conquer a very specific staircase of resistance. First, they must break out of the current compression ceiling at 65.3K. Then, they have to push through the heavy technical resistance starting at 66.6K. And finally, they have to absorb that massive wave of selling from short-term holders trying to break even at 67.5K. Only by clearing these three hurdles on high volume can we officially declare a true breakout.
Which leaves us with the ultimate question as we wrap up today's explainer. With a coiled spring of the 65K compression phase tightening every single day and billions of dollars in ETF power-ups continually flowing in, is this going to be the week the institutional force finally shatters the retail shield? The battlefield is set, the data is clear, and the next move is going to be absolutely spectacular to watch. Stay focused, keep learning, and I'll catch you in the next explainer.